Good afternoon, one and all. My immense pleasure to welcome you all for the joint seminar conducted by Sivasi branch of SISA of ICA. First of all, happy to introduce our dynamic chairman of Sivasi branch of SISA of ICA, CAP Selvaraj sir. CAP Selvaraj sir did his schooling in TNPM1 Higher Secondary School, Talavayapuram during 1986. He did his BCom degree in Rajabalayam Raju's College of Arts and Science, Rajabalayam from 1986 to 89. He underwent articleship training at KT RS and Co Chartered Accountants, Rajabalayam. He has passed the professional course of CA curriculum at May 1995. He also gave the intermediate qualification in the CMA course, which is conducted by the Institute of Cost and Management and Accountants of India. He has the immense experience in practice the field of accountancy under the name and style of P. Selvaraj Associates since 1995 in Rajabalayam and Sengotai. He specializes in preparation of project finance and direct taxation. He also took the part-time lectureship in Acadia Women's College, Rajabalayam, about the income tax paper from 1996 to 2016. He has done more than 40 career counseling program for the past 3 years. He is the secretary of Rajabalayam Chartered Accountants Association, Rajabalayam. He is the vice president of Rajabalayam Raju's College Alumni Association. He is the one of the director of the Bhubadi Raju Cooperative Bank Limited, Rajabalayam since 2016. He is the one of the member of managing committee of Sivasi branch of SIRC since 2017. He held the position of SICASA chairman for the year 2017-18, CP chairman for the year 2018-19, and vice chairman for the year 2019-20. Presently, he holds the position of chairman of the Sivasi branch for the year 2021. The Sivasi branch of SIRC won the best and first SICASA award under his chairmanship of SICASA from the central minister in Delhi. Now, I happy to request our chairman to deliver his welcome address. Welcome, sir.
Thank you, ma'am. Good afternoon, Monanda. I am happy to inaugurate this session. So, as a chairman of the Sivagasi branch of ICA, first of all, I would like to extend my sincere thanks to the management committee of the Adi College Engineering and Technology for giving the opportunity to Sivagasi branch. So, though they are working in the far away from our Sivagasi branch, but they have extended their helping hand and cooperation with our Sivagasi branch is mind-blowing. So, for that purpose, I am going to convey my sincere thanks to management and the principal for giving the opportunity to the Sivagasi branch. So, on behalf of the Sivagasi branch members and students, I would like to extend the heartfelt thanks to all those things. And I would like to welcome our today's speaker of the session, so Muthurajan. So, he is also from the Chennai and he is extending the helping hand to our Sivagasi branch. So, I am thinking that it is a miracle for our Sivagasi branch doing the joint seminar with Chennai based in engineering college. So anyway, the staff of the institution and the students of the institution will get more benefit from the points and provisions discussed by the Muthurajan. So I am welcoming Muthurajan sir, and I would like to welcome all the staffs and viewers of this program for the accepting the especially for this cooperation to the Sivagasi branch. Okay. And since the topic we are going to discuss by the Muthurajan sir is income tax. So I have handled the income tax paper for the BCom degree course and the BCom corporate secretary course since 1996 to 2016. I know that how the difficulty behind the teaching of the income tax. So Muthurajan is well expert and he will give the clear-cut provisions of the income tax, and I hope that the speech will be more benefit to the staff of the institution and the studying students of the institution. I would like to welcome you all once again for this wonderful program. Welcome you all. Thank you.
Thank you, sir. Now I welcome to Dr. Devraj sir. Welcome, sir.
Thank you, sir. Welcome.
My immense pleasure to introduce our chief guest, Dr. A. Devraj sir, principal of Adi College of Engineering and Technology. He did his mechanical engineering, Thandai Periyar Government Institute of Technology, Velur. He did his MTech in engineering, energy engineering in Bharathidasan University campus 2002. He did his MBA in Alagappa University, Karaikudi in 2006. He did his PhD in mechanical engineering in Anna University in 2012. He has 24 years of experience in teaching field. He has published 53 papers in international journals. He has also published in 21 papers in international conference and 4 papers in national conference. He has invited for guest lecture and chief guest for various colleges and schools. He has guided the more than 30 projects for UG and PG. Now I invite Dr. Devaraj sir give you a special address. Welcome, sir.
Thank you for your introduction. First of all, this is the first function for chartered account and income tax related webinar. We are very happy to participate in this webinar. So, usually the engineering students are always looking for technical related webinars and going behind that. Whereas this is a new one. Actually, it is a record for every engineering student, but nobody has concentrated. This is the first attempt we are hearing for this webinar. So I already communicated to all students and staff to participate in this useful session. Actually, many of the students and faculties are unaware of the income tax related issues and what is taxable amount, how to uh, pay the tax, and what are the procedures involved in it. These are all new concepts for us. So, like our college students and staff members, I am also very much eager to participate in this event. And on behalf of our Adi College of Engineering and Technology Management, and we express our sincere thanks for the organizer to join this webinar to give the seminar for us, and really very happy occasion for us. So I hope this seminar will have great thought for our students and staff members. I wish for the participants, speakers, for the great success for this seminar. Thank you, one and all present here. We are very happy to participate in this seminar, and we will be there till this end of the seminar. Thank you once again for your giving me opportunity to participate as a speaker.
Thank you, sir. Happy to introduce our today's resource person, C.R. Muthurajan sir. He did his BCom in Ayananar Janagiammal College, Sivagasi from 2005 to 2008. He is associate member in Institute of Chartered Accountants of India since February 2012. He has handled more than 50 clients till date on my professional career. The key sectors includes audit of revenue cycle management service, audit of automobile parts manufacturing companies, audit of cost plus companies, audit of hospitals, audit of engineering companies, audit of printing companies, audit of retail trading companies, audit of FMCG companies, audit of oil refinery. He has secured state first rank holder in higher secondary in commerce and auditing. He has diversified audit experience in terms of business category and also in terms of size of business. He has represented UI India's master trainer for a training program happened in Netherlands. He has awarded Team Accelerator Award for the excellence in working achieving one of the clients. He have core competency in financial statement reporting and planning and management, internal control. Also, he is visiting faculty for accounting standard class for CA Inter and CA final student in Sivasi branch of Institute of Chartered Accountants of India. He is presently in director in Manohar Chowdhury Associates and Chartered Accountants Chennai. Now I hand over the session to CA Muthurajan sir. Welcome, sir.
Thank you. Thank you. So welcome one and all. I know it is very difficult to handle an afternoon session, but I will make it more engageable. And first of all, thanks for Sivakasi branch of ICA for giving me this opportunity. And also I thank the Adi College of Engineering for uh, uh, attending this webinar. So I'm always happy that to take sessions for somebody who is not in the profession, meaning to take a session for tax session for an engineering professions. Why is that? Is we always try to miss out something as we concentrate on very high issues and maybe miss out on the basic issues. So when I discuss with an engineering candidates, so always they are new to the tax and they can ask questions uh, which is out of box, which sometimes make us also sometimes things. So I'm very happy to be here for today's seminars. Will make it interesting and also make it useful for you. So any questions you can post it in the chat box here, or you can ask me at the end of the session as well. So whatever responses I could give immediately, I will give immediately. If in case anything is very unique, I will take it at a later stage. So I have made a small presentation for today's seminar. So I will just share that presentation. Can somebody tell me whether the presentation is visible and I am audible?
Yes, sir. Yes, sir. Visible,
Yeah,
sir.
sure. So I'm just so what I have planned is today is as I'm taking seminars for the engineering candidates. I will be just covering very basic concepts in income tax, how income tax works, and as you will be aware, every year the finance minister presents changes in the income tax act and what are the changes in provisions. So, as usual, Finance Minister Mr. Nirmala Sitharaman has presented Finance Act 2020 some 10 months before, and there are some changes which are effective for uh, April 20 to March 21 financial year, which I will cover it up. So I am covering as most of them are likely to be salaried professionals which are listening this seminars. I have modified this presentation only to be useful for the person who are salaried professionals. And recent changes also will be covered only for the salaried professionals. So with these notes, I will just start my presentations without wasting any further time. So as we see, Income Tax Act was founded in 1961, and which covers which is the base section for charging income tax in India. And how it is charging income tax in India is it basically covers five heads of income. So any amount received from any person, any amount exchanged between any person, which is getting taxed under five heads of income. So first head is that income from salary. The second head is that income from house property. The third head is that business or profession, and fourth one is income from capital gains. And the last and residual head is that income from other sources. So why it is required? So the income tax is covered broadly under these five heads. So income from salary. Why income from salary? So all salaried professionals are covered. So house property. So who are having a house owners, they collect rent. So that is charged under house property. And who are do businesses and chartered accountants will be covered under business or professions. Whatever the income they earn from their business or professions, and capital gain is something like you are selling your assets, you are selling your land, you are selling your building, so you are selling your shares. So those are covered under capital gains because they are all capital assets under the income tax act. So other sources is nothing but if any other income, if you are not able to fit in any other heads, any of these four heads, then it is called other sources. If I want to give you an example, say for example, you are walking in a hotel, say for example, a temple city in Madurai. So you are just walking in. When you are entering the hotel itself, you are finding a box lying outside the hotels, and when you there is no, the box was unattended. When you opened the box, there was the box full of gold, and you have lifted it and you are carried to your home. And this is a typical example of an other sources which no one knows that how you earn this income, and you will not be able to fit this income to salary, house property, business, or capital gains. But you can ask me that question saying that I have never earned this income, so you have just taken it from somewhere. So that is why it's called other sources where you are not able to fit in, but somebody one fine day you try to encash it, this gold from jewelry you get caught through some way, through either through your bank statement, or jewelry has given your PAN number to somewhere else. So income tax authorities are asking for the source. So that time, if you ask me how it is getting charged, so it will be charged as a income from other sources. So this is the residual sections. Wherever you're not able to fit in any income, it will get fit here. So I have covered simple all the five heads of income in the next slides, and also basic other provisions of income tax. So coming to income from salary. So why income from salary? Say for example, a college staff gets salary income from the college. Not only income from college, they also receive some kind of, if they supported a student in the project, they may be getting some incentive from, or some kind of remuneration from the student as well. If they attended, if they taken guest lecture in some other colleges, they will get some money. Whether all are chargeable as salary, the answer is no. Then what are the amounts to be charged as a salary, and what other amounts will be charged? If you ask me that question, the simple question which we should ask ourselves is that whether there is a employer and employee relationship is there or not. So what is an employer employee relationship? That should be, the Income Tax Act explains like contract of service and contract for service. So what if you are doing a contract of service, which means you are obeying whatever your bosses says. So you are just obeying your bosses. Your principal says something, you are doing it. Your principal says you have to take this subject, you are taking it. So which means employer employee relationship exists, which means those amounts are charged as a salary income. So whereas when you are going for a guest lecture, or when you are supporting a person in terms of like, you have supported them in the project or something outside the purview of college, which you are supporting, those incomes are not arising out of employer employee relationship. Basically they are saying, say for example, a cracker dealer, a standard fireworks is there will be so many dealers will be there. The dealers operate on their individuals, though they get money from their customers or the commission from the principal, but they operate on their own, they decide on their own. So those are all not a contract of service, those are all contract for service. So if you are doing contract of service, then it is a employer employee relationship. Whatever amount you get it from your employer is called a salary income, which is chargeable under income from salaries. So this becomes really important under what head you are putting, because the all the provisions of income tax gets changed for each head of income. So it is better to understand under which head you have to charge your salary. So this is called income from salary. So under this head, there are various deductions you are getting, various allowances you are getting. So those are all, let's see, I have pointed out here some of the allowances which we normally get during an employer-employee relationship. Example is a house rent allowances. So these allowances, income tax. So we also incur some of, not only revenue, salary is our revenue. So we also incur some of the expenses. But Income Tax Act is not giving entire deduction for our expenses. Say for example, I have a sister. I have taken loan for my sister marriage. So can I claim, because that interest is an expenditure. The expenses I am going to incur is a expenditure, but those expenses are not allowed. Income Tax Act not allows all expenditure, but it gives allowances for certain expenditure against your salary. Those I have listed down some of the things which we can see. So house rent allowance. So house rent allowance is normally, they are not giving you house rent, means you know that we are paying rent. So basically there are three categories under which they are giving exemption for a house rent allowance. First thing which you have to consider is where are you living in Chennai, metro city, non-metro city. How much rent you are paying, how much you are getting, and how much of the rent is 10% over your basic salary. So like this, there are three categories which you have to work out your rent: actual receipt, actual payment, and are we living in a metro city, non-metro city. Metro city means 40% of your salary is allowed. Non-metro city is 50% of your salary is allowed. So after computing all these three things, whichever is lesser will be allowed as a house rent allowances, which you can claim against your salary. And one of the important thing is that normally leave travel allowances. What is leave travel allowances is Income Tax Act allows salaried personnel to travel along with their families anywhere and claim that expenditure. What kind of expenditure I claim means I can claim my travel expenditure alone, meaning not stay expenses, just the travel tickets, air ticket, or it's a bus ticket, or it is a train ticket. So those expenditure alone I can claim. So how I can claim? I can claim two journeys in a period of 4 calendar years. Meaning, so 4 years I can do two journeys I can do. So it is allowed even for a family, even for a family in the sense spouse, two children, not three children. If more than three, sorry, more than two, it is not allowed. Two children and any dependent brothers and sisters and dependent parents. So it is allowed for even family as well. So leave travel allowance, it is also one of the main concept which normally people claims in their income tax. House rent allowance is one of the important thing which people claims. Apart from that, they are giving the standard deduction of 50,000 rupees, irrespective of whether you're incurring expenditure or not. Standard deduction is given. And allowances actually received. There are allowances. There are two types of allowances. On the left side in my presentation, you can see there are two types of allowances. You will be able to appreciate the difference once I explain. Allowances actually received or spent, whichever is lower. If you want to give me an example, say for example, there are travel allowances which will be given to the employees, but those allowances are allowed as a deduction based on how much is the actual spend. Suppose college is giving a travel allowances of 1,000 rupees per month, but the spent is only 800, then only 800 is allowed. Balance 200 is chargeable to tax as a salary income. The next set of allowances is allowances which are received but taxable only based on the limit which is prescribed in the act. Which means, example, if I have to give, uh, there is a children school allowances, which is per children 200 rupees, 300 rupees allowed. So irrespective, even your company is paying 1,000 rupees per month, that allowances is only restricted to the limit which is prescribed in the act. So there are two types of allowances: allowances received but spent is only allowed. Whichever is received or spent, whichever is lower is allowed. One is that allowances received are allowed under the act, whichever is lower is allowed. So the next concept is on the retirement benefit. The retirement benefits, gratuity. So gratuity, most of the employees gets if they completed 5 years of service with the company or with the colleges, etc. So those retirement benefits are again allowed to some extent based on the workings which is given in the income tax provisions. Example, the gratuity is allowed to a maximum extent of 20 lakhs. If you received 25 lakhs from the company, the balance 5 lakhs will be chargeable to tax under the income from salaries head as a salary income. The next most important concept in this COVID situation, which I'd like to discuss I'd like to discuss in this seminar, is arrears of salary. The arrears of salary. See, most of the companies now, I have seen companies not deferring their salary payment or not paying itself the salary. But it's which when I said defer, they are going to pay the salary in the next year or in the coming years anytime soon. So what will happen if I am not receiving my salary and I'm receiving the salary next year? So there might be situations where 1 year taxable limit is. I will just by giving an example. tax rate is 10%, whereas next year tax rate is 20%. Since the company has not paid you salary, which your salary would have taxed at 10%, you are receiving unnecessarily because of management default. You are receiving your salary next year, and your salary is going to get taxed at the higher rate of 20%. So the Income Taxes Act appreciates these kind of situations and given some kind of relief to persons who is receiving arrears of salary. So in case you have arrears of salaries, you may consult a chartered accountant. Maybe he will be able to support you in detail. However, I am just indicating that if you have arrears of salary, there is a relief. You can pay only to the extent of 10% or the current year tax rate, whichever is beneficial to the assessee. That the relief is available to the assessee. So you can continue to pay tax in case your previous year tax on which you would have received your salary and the salary would have taxed. If it is beneficial, then you can pay that tax alone. So that kind of relief is available to the assessee under income from salaries. So that is on arrears of salary. So this is the basic concept of income from salaries, which normally we see. Other than that, there are many provisions which normally will not apply for a common person. So these are the income from salaries sections. So with this, I am just moving on to the next head of income, which I have mentioned earlier, which is income from house property. So, income from house properties, I can see there are two types of income. So there are two types of income from house properties. I think it's very, very common. You would have also seen it is just a technical word: let out property and self-occupied property. Just நான் வாடகை வீடு வச்சிருக்கேன் plus நான் ஒரு சொந்த வீடு வச்சிருக்கேன். So the provision differs based on what kind of property you have. Let out property, I rented that property. Self-occupied property, that is my own property. So let out property, net result of computation means I am receiving rent. நான் வாடகை வாங்குவேன், அதுக்கு எனக்கு எக்ஸ்பென்சஸ் கூட இருக்கும். எக்ஸ்பென்சஸ் என்ன மாதிரி இருக்கும்? யூ கேன் சி டவுன். ப்ராப்பர்ட்டி டேக்ஸ் கட்ட வேண்டியிருக்கும் எனக்கு. ஸோ அண்ட் நான் லோன் எடுத்திருந்தேன்னா அதுக்கு இன்ட்ரெஸ்ட் பே பண்ண வேண்டியிருக்கும். இன்ட்ரெஸ்ட் ஆன் பாரோட் கேபிட்டல். ஒரு ஹவுஸ் கட்டுறதுக்கு லோன் வாங்கியிருந்தேன்னா ஐ ஹாவ் டு பே ரெண்ட். ஸோ ஹவு மச் இஸ் அலவுட்? So any amount of income or loss. If it is a let out property, the Income Tax Act allows any amount of income or loss. Any amount of loss in the sense, suppose initial period your income will be less. You might be receiving 10,000 rupees rent, whereas you will be paying as much as like 20,000, 25,000 as a interest payment. So your initial years you will be facing losses. So those losses are allowed irrespective of the amount for a let out property. Whereas coming to the same to the self-occupied property, so in case you are paying more than 2 lakhs of interest, then your loss is restricted to only 2 lakhs after netting of your income. Suppose you are earning monthly 5,000 rupees as rent, so 60,000 rupees rent, whereas you are paying 5 lakhs of interest on borrowed loan. So your loss is allowed only to the extent of 2 lakhs. So whereas let out property, the entire interest or entire loss is allowed because those the expenses you are incur. So apart from that, you will be getting a standard deduction of 30% on your income from house property, whether it is a let out property or self-occupied property. So one more thing which I want to clearly mention in COVID-19 situations again is unrealized rent concept. What is an unrealized rent concept? Because most of the chief minister announced or prime minister have announced that the tenant is not required to pay rent to the owners. The landowners no need to charge rent. So those kind of concepts and all came. So but income tax never allows like that because income tax act wants 12 months rent to be charged to income from house property. So again, however, income tax also appreciate if there is a real situations that you are not able to realize your rent for some unknown situations or unwarranted situations, you are not able to collect your rent. So there are specific principles which is given, which is called rule 4 under income from house property provisions. So if you read that rule 4, it has to be real situations, and the you should have taken appropriate steps to collect the rent. It is beyond your limits that you are not able to collect the rent. So those scenarios you can say this is are all unrealized rent, and you no need to show us a rental income. Again, the concept of fair rent. What is a fair rent? Because say for example, I have given one property as rent to my sister. So it's my sister, so I have given it for, say, the property, if I given in the market, if it went is it will be 10,000 rupees. But if since it is my sister, I have given it for 2,000 rupees. But income tax act never allows all those things, so you have to charge the fair rent, which means though you charge your sister only 2,000, you are supposed to show income as 10,000. So that is called concept of fair rent under income from house property. So these are the provisions, broad simple provisions under income from house property, the second head of income. So with this I am moving to the third head of income. So third head of income, again, it's a fairly simple income from capital gains. So income from capital gains. What is income from capital gain? Is here the most important thing is that there should be a capital asset. Selling that capital asset will become a capital gain or capital loss. What is a capital asset? Capital asset is nothing but it's a fixed asset. In a simple terms, if I want to put, or fixed assets, it's a land, building, furniture, vehicle, jewelry, shares, everything can be a capital asset. But there are some provisions which we need to identify whether to classify whether the asset is a capital asset or not. Example, if the asset is used for personal purposes, not for anything relating to your business, then it is called then it is not a capital asset. Anything relating to your personal, it is not a capital asset. Anything used for business, then it is a capital assets. So those assets, if you are selling, then it is called then it will be covering under income from capital gain. So those gain can be categorized, or gain or loss, it can be anything. So it can be categorized into long term and short term. Why it is a long term or short term? Because the tax rates are entirely different how you are charging that as a long term or short term. If it is a long term, straight away 20% tax. If it is a short term, straight away 10% tax. So how can I classify something as a long term? What is the period? Anything prescribed under the act? If you ask me like that, so then yeah, they have prescribed something. They have again categorized into three categories of assets. One, yeah, shares. Shares, everyone knows shares, right? So shares, if it is more than 12 months, if you are holding that share with you and you are selling that after 12 months, it becomes a long term capital gain or loss. If you are holding private company shares, listed company shares 12 months, a private company shares, or it's a land or building, if you are holding it for more than 12 months, then you're selling that asset, then it is called long term capital gain. So in other cases, they allowed 36 months. If you are holding any asset, other assets for 36 months, then it will be categorized as a long term capital gain or loss when you are selling. Otherwise, it will be called a short term capital gain or loss. So there will be a practical difficulties or a practical challenge you might have seen, or if you guys would have seen a Rajini Murugan movie, where Sivakarthikeyan tries to sell an old house in Madurai. He wants to. So if you see that houses when they bought, it will be at 2 lakhs or 3 lakh rupees when they bought initially, the forefathers. But when you are selling that asset, it might go for around 6 crores, 7 crores. So are you going to pay tax for a gain of 6 crore minus 6 lakhs, which is the cost of the asset when when my forefathers bought? Really not, because I cannot pay. I, I should have actually paid, but the Income Tax Act gives you a leverage. I'm now, so I hope you everyone understood my example. So in that, Sivakarthikeyan is trying to sell the forefathers property, which bought maybe 50, 60 years ago, where the property might be worth only 6 lakhs that time. Now he is trying to sell at 6 crore rupees. So basically, you are achieving a gain of 6 crore minus 6 lakhs, but the Income Tax Act gives something called indexation. Please remember the term indexation, because it will be useful for you in future. So what is indexation? Is making the property current value. You can value the property with current value. So you are supposed to make indexation. If you do indexation every year, you can see the Income Tax Act there. Finance minister will be do this year index is this much. So you have to supposed to do a index, uh, which basically try to do value that asset at today's rate. So 6 lakhs that day. So today, if you sell that asset, it will be a 5 crore 50 lakhs. So it might come to 5 crore 50 lakhs. So after selling that asset, you are getting 6 crores. So that 50 lakhs alone will be taxed rather than the charging 6 crores minus the 6 lakhs. Hope you understood the concept. So the indexation concept comes in capital gains. So indexation concept basically gives the assessee in the sense who is paying the tax, uh, helping him to value the asset, what will be the worth of the asset at today's date. Then that asset was selling to a customer at 6 crores. So only the differential is only taxable. That is called finding out the cost of acquisition. The next concept in capital gain is that cost of improvement. So what is cost of improvement means, that six lakhs as the asset which I told you, maybe the families would have spent so many expenditure on that asset over the period of time, maybe 5 6 years they would have renovated the house many times. So those are called concept of improvement. So those improvement cost also I can value it current dated and add it to the asset value. Then I can compare the selling price and the asset cost which I arrived. So for that difference alone, I have to pay capital gain tax rather than charging 6 crore minus 6 lakhs. So I hope everyone is clear on income from capital gains. So this is the broad concept of income from capital gains. So next is on the income from other sources. Actually, I have explained this first itself. So whatever is not covered under the previous heads of income, it is getting covered, because most of the time income tax authorities seen assessee escaping, saying that my income is never covered under any heads of income. I'm not required to pay tax. So this is the residual sections. If it is not covered under any other heads, please get charged under this head of income. So this section basically covers the bogus transactions. What is bogus transaction? Is that without any reasons, father transferring to daughter, father transferring to wife, or some binamis they are transferring. So any amount you are getting more than 50,000 from anyone, amount this will be chargeable under this income from other sources. It may be a property, it may be just money, it may be a movable property or immovable property. If you are receiving more than 50,000 without paying any consideration, you have not paid consideration, and you are just receiving the property or money, then it is chargeable under income from other sources. So these are the broad four heads of income under which income tax is charging a normal individual. I'm not in this seminars we are not touching income from business or profession, as it is not relevant for us. So I'm just covering which is for a normal individual, what are the income tax provisions which they should aware of, or where they should ask their CAs, or when they are filing the return of income every year. So these are the basic concepts. So other than that heads of income, there are other few concepts which I will try to cover, so that it will be useful for you in future. Next is the setup. I have told you about losses, the house property loss I told, capital gain losses I have told. So salary, like, we cannot face any loss because salary is just income we receive. So apart from that, so if I am facing loss, what I am going to do with the loss? So whether income tax helps me with that loss, it will not help you to repay your loss, but it will help you to set off. You can use that loss. நீங்க வந்து next yearல அந்த loss வச்சு, in case you are earning profit, you can set off that loss. Suppose next yearல, this year you have 100 rupees loss, next year you earned 500 rupees income, net income to be taxable. You can set off this 100 against that 500 and pay tax only for that 400. But how many years I can keep carry forwarding? I never earned in my life profit. Then how many years I can carry forward? You can see the blue color chat box, which has 8 years you can carry forward. So everyone can carry forward losses to the extent of 8 years. There are some catchy or small star mark the income tax authority says, you have to file your return of income on time. If you are not file your income on time, then you are not eligible to carry forward your loss uh, further. So your loss will get hold. You are not eligible to carry forward your loss further. So always, in case you are having a loss, please go and file your return of income on time, so that you don't face any penal consequences. So again, I have told about how many years can you carry forward. Can I set off any loss against anything? Means there are restrictions. You cannot carry for. You cannot set off your. You cannot set off your, say for example, the first box is lottery income. You cannot set off your lottery income losses with salary income. So there are some set of rules applicable. You can set off only your lottery losses with the lottery income if at all you are earning that year itself, but you cannot set off your lottery losses with the salary income. uh, so long-term capital loss, we have seen before, few slides before, long-term capital gain. So there might be a long-term capital loss also. If you are selling a property for a loss, which is a long-term capital asset, is called long-term capital loss. You cannot set off that loss with any other profit of from the any other head of income. You can set off that loss only with the long-term capital gain if you are earning in any year, but you are not earning in any year, it will be lapsed after 8 years. So, like that only, loss from house property. There are special provision. You can set off loss from house property to the extent of 2 lakhs with the other heads of income, and carry forward the balance loss to the next year and keep setting off against your loss from house property. So these are the set of and carry forward of loss provisions which is given under the Income Tax Act. So these are the few provisions which I wanted to discuss with you. The next is on what the Finance Minister has discussed this year, Finance Act 2020. So the finance. So these are all basic things which I may skip because of time constraints. We can see the next slide. So the finance minister that came out with the new tax rates. So you can see on the right side that's a new tax rate. There is a drastic decrease in the tax rate which the finance minister has given. Sorry. So though they have given change in the tax rate, but if you see on form, there is no change. I will explain you why, and we have to be very careful in selecting or adopting the new tax rate. So from this year onwards, there will be two tax rates available. The assessee or the income taxpayer can select whichever tax regime they want. They can go with the existing tax regime, or they can go with the new tax regime. Why it is a new and why it is an existing? As we seen, there are so many exemptions. So if you see this concept, income from salaries, there are so many allowances. So if you went to the new tax regime, you are not allowed to claim any of the allowances, and your income will be straight away taxed at the particular percentages which is given under that slab rate. So you are not allowed to take any of the allowances or exemptions which are given under Income Tax Act. So we can see what are those allowances which are not available in case you are selecting the new tax rates. But if you are going with the existing tax rate, you are allowed to claim all the allowances and all the exemptions, whatever you want. Then you can ask me a question. Then why at all a new tax rate is uh, beneficial for someone? It may be beneficial for a person like me. Why I'm saying is that, say I am the person, I earn very good income, but what happens is that I have enormous loan. I don't have money to invest in anything. When I don't have money to invest in anything, because I have some personal, I have told you that I've taken loan for my sister's marriage, and whereas the act doesn't allow anything interest expenses which I incur as a deduction. So I don't have money to invest in LIC or fixed deposit where I can claim deductions under the Income Tax Act. At least I can go to the new tax rate and save by way of lesser tax rate. So whoever has good investment plans, like they have money to invest in LIC, PF, fixed deposits, shares, etc., they can go with the existing tax rate where the person don't have, they are fully committed and they don't have any investment plans. It's better for them to go for the new tax rate. At least they can save by way of lesser tax rates. So I'm just giving a next slide. I'm explaining which are the deductions which are not available. Maybe in case if it is required, I can share this slide, because there are many deductions which we need to discuss, that which are not available in case you are taking a new tax regime. So people should understand that these are all not available for them in case they went for the new tax regime. So they should be very careful in selecting which tax uh, to be followed. So exercising the option of which tax bucket they should follow, new tax rate or old tax rate, is the option of the assessee. So when they should exercise that option? When they are filing the income tax returns, which normally comes in July of every year. So next year July, when they are filing, before filing the return of income, they should select which, whether they are going for a new tax rate or old tax rate. They should decide. So every year they have an option for a salaried employee. Every year they have an option. They can either select new rate. This year they can select new rate. Next year they can select old rate. So they have an option every year. But if you are having a person having a business income, professional income, once option is exercised, you cannot change back your option. So these are the beneficial tax savings you have because of lesser tax rate. However, you are supposed to see what are the investment plans you have, and last column you can use as a tracker and update and see. So I have an LIC. Okay, can I not, if I not claiming that LIC, still is the new tax rate beneficial to me? Because you have to forego your investments when you are selecting your new tax rates. So you have to be carefully analyze which tax rate you should go, and accordingly select new tax rate you want to go this year, or old tax rate you want to go this year. You better to consult a CA for at least 1 year or 2 year, then I think you can yourself will be an expert in this. But it is just an indication for you. We can give you as of now in a 1 hour seminar. You can maybe reach out to any one of us. We can guide you. Depends on your investment plans. So like this, you have to work out and see. See, in this case, there are so the person is earning 17 lakh 50. In the second scenario, also 17 lakhs 50. The only thing is that the first scenario, the person has 4 lakh 50,000 exemption or deductions they can claim, which means they have invested in LIC, invested in fixed deposits, some kind of invest the housing loan interest they have, some kind of deductions they are claimable, whereas here 1 lakh 50 only claimable in the second options. So they worked out under the current regime. You can see the first call, left side current regime and the proposed optional regime. Again current regime, proposed optional regime. In case of first scenario, they in the old, in the new, sorry, in the new scheme, they are paying more tax, 2,62,000, whereas in the current regime they are paying only 2 lakhs, which means existing tax rate. Whereas coming to the second scenario, in the current, in the existing tax, they are paying 2 lakh 92, whereas the proposed new tax rate, as I informed to you, they have pay you only 2 lakh 62, because it's just a reduction in tax rate and they don't have any deductions or exemptions available with them. They can go for the new tax regime. They at least saved 30,000. So other amendments now, dividends. I think everyone knows dividends. If you are having shares, you will receive dividends. Dividends are now taxable under the hands of a tax receiver, and uh, there is interest on loan. There is a special interest on loan which is given when you are buying the first time property. Those are all extended till 2021. You are getting additional benefit of 1 lakh 50,000. So that is one of the amendment now. So apart from that, you should also aware of penal consequences of not filing tax on time. If you are not filing a return of income on before July of every year, you have to pay 1% tax per month on every month delay. And next is on 234B. In case you have not paid 90% of the tax which you are supposed to pay for that year before filing the return of income, then you are supposed to pay 234B interest 1% per month for the period of delay, and 234C, which says every quarter you should have paid at least a specific percentage of your tax liability for the year. In case you are not paying that, again you are attracted with the penal consequences, again 1% per month for the delay in remittances. So these are the penal consequences you should aware, because when you go for just filing of return of income, your auditor will say you are supposed to pay a fine of this much. So please aware of these things in initial itself, so that you can avoid paying interest to income tax authorities. I think that's all from my side. I'm sorry, little bit it is very fast. In case you are not understood anything, you can always reach out to me. If you have any questions, please let me know. In case you have any questions, you can drop your questions in the chat box. I understand you have one more session at 3 o'clock. So we can have, you
It's
have
one of the
another 5 minutes. Yes.
Thank you, sir. Thank
Yes,
you
sir.
so much, sir.
Yes, sir.
Good
Any
afternoon, and all.
question?
Again,
Yes, sir. Any questions you have?
anyone doubts, please leave the comment in the comment section box.
Even very basics also fine, or you have seen anywhere or in your personal things if you have faced anything. Please let me know.
Sir, this is a doubt asked by Anand MG. Can you tell about 234 FLP?
Okay. 234F is not for individuals. One minute, I'll just let you know. I think it is for company side where when you're filing the delayed TDS returns, not from assessee side, it is for the tax deductors when they are not remitting TDS statements on time, they are supposed to pay interest for those delayed submission of TDS statements. Uh, Anand G, can you tell me like you're a student or staff or from the college finance team or something like that? So that accordingly I'll answer your question. Anand Ji, or in order to simply answer your questions, it is just a delay in filing TDS statements. It's from the company side, not from the assessee side. Any other questions? I hope you got clarity on what is 234F. Like 234A and B and C is for the SSC and remaining things it's for the tax deductors.
So shall I move on to the next program, sir?
Yes, sir.
Okay, sir. Thank you, sir.
Thank you. Thank you, sir.
Good afternoon, one and all. It's my immense pleasure to deliver the vote of thanks. First of all, I thank Chairman of Sivasi branch of SRSF ICI, CAP Silvaraj sir, for arranging the seminar. Then I submit my gratitude to Devraj sir for giving opportunity to conduct the seminar. Then I extend my sincere thanks to today's resource person, CA Muthurajan sir, making the session more giving making the session more practical and valuable information. Then I would like to thank all the staff members and all the participants of the program. Let's open up the meeting with national anthem. Thank you all.
जनगणमन अधिनायक जय हे भारत भाग्य विधाता पंजाब सिंध गुजरात मराठा द्राविड उत्कल बंगा विंध्य हिमाचल यमुना गंगा उच्चल जलधि तरंगा तव शुभ नामे जागे तव शुभ आशीष मांगे गाहे तव जय गाथा जन गण मंगलदायक जय हे भारत भाग्य विधाता जय हे जय हे जय हे जय 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 हे
Thank you so much for giving the opportunity, sir.